stop whatever you are doing right now. Something insane just happened while America was fast asleep. Silver just hit $125 an ounce on the Shanghai Futures Exchange. Let me repeat that. $125. Meanwhile, on the other side of the globe, U.S. prices are lagging behind at just $110. Let me repeat that number because it sounds impossible. $125. Meanwhile, take a look at the price in New York. The COMEX price is struggling to break $110. Do the math. That is a $15 to $17 spread per ounce. A 15% premium for the exact same physical asset, just sitting in a different vault. This is not a glitch. This is not a fat finger error by some intern at a trading desk. This is the physical market screaming at the paper market. This is the moment we have been warning you about for years. The great decoupling is no longer a theory. It is happening right now, in real time. For decades, the price of precious metals has been dictated by a handful of banks in London and New York trading paper contracts. But today, the world's largest manufacturer, China, just flipped the table. They are effectively saying, we do not care what your computer screens in Wall Street say silver is worth. We need the metal, and we will pay whatever it takes to drain the global supply. If you think this is just another daily fluctuation, you are mistaken. When an arbitrage gap this massive opens up and doesn't close, it means the plumbing of the global financial system is broken. It means the physical metal is stuck. It means the vaults are emptier than they are telling us. So what is actually happening behind the scenes? Why is China panicking to secure silver? And most importantly, if the price in Shanghai is $125, how long until New York is forced to match it or break completely? Welcome back to the channel. Today, we aren't just reading the news. We are dissecting the collapse of the paper pricing mechanism. Let's dive in. To understand the magnitude of this event, we need to strip away the noise and look at the raw data coming out of Asia this morning. We are only a few hours into the Monday trading session in Shanghai. Usually, these sessions are quiet. But today, volume exploded. The price action on the Shanghai Futures Exchange, SHFE, went parabolic, ripping $6 higher in a matter of minutes, setting a record high of approximately 28,000 yuan per kilogram. When you convert that to US dollars in troy ounces, you get that magic number, $125. Now, look at the Western response, or rather, the lack of one. While Shanghai was mooning, the COMEX in New York and the LBMA in London were sluggish. Yes, they were dragged up to the $109, $110 range, but they refused to close the gap. The death of arbitrage in a healthy, functioning market. A gap like this shouldn't exist for more than a few seconds. This is Economics 101. It's called arbitrage. Here is how it should work. A sophisticated trader sees silver is $110 in New York and $125 in Shanghai. They immediately buy the cheap silver in New York, charter a plane, fly it to Shanghai, sell it for $125, and pocket the difference. If thousands of traders do this, the buying pressure in New York pushes the price up, and the selling pressure in Shanghai pushes the price down. Eventually, the prices meet in the middle. The market stabilizes. But that is not happening. The gap is sitting there. It is widening. Why? Because you can't arbitrage what you can't get your hands on. This $17 spread is the market telling us that physical friction has reached a breaking point. There are three likely reasons why this arbitrage window is broken. Export controls. China has been quietly tightening controls on the export of strategic metals. Once silver enters China, it doesn't leave. It's a black hole for precious metals. Logistics failure. There may not be enough secured transport capacity to move the thousands of tons needed to crush this spread. The eligible illusion. This is the scariest option. The silver sitting in Western vaults, labeled as eligible for delivery, might not actually be for sale. It's owned by long-term holders, ETFs, or wealthy individuals who have no interest in selling, even at $110. So, the paper traders in New York are trading contracts back and forth, pretending the price is $110, while the actual physical buyers in Asia are transacting at $125. We effectively have two different prices for silver on planet Earth right now. The inventory drain. We also need to talk about the COMEX registered inventories. For those new to the channel, registered silver is the metal that is actually available to be delivered to settle a futures contract. We have been tracking this data for months. The trend is undeniable. The vault is draining. Every time prices dip, we see massive withdrawals. Every time prices spike, we see massive withdrawals. It doesn't matter what the price action is. The metal is leaving the system. Shanghai is now bypassing the Western price discovery mechanism entirely. They aren't waiting for London to fix the price. They are engaging in what looks like a hostile takeover of the physical market. Why now? Why is January 2026 the moment China decided to break the market? To understand this, we have to stop looking at charts and start looking at the real world. We need to talk about industrial necessity and geopolitical warfare. 1. The solar singularity. China is not buying silver to make jewelry. They are buying it to dominate the energy future. Silver is the most conductive element on the periodic table. There is no substitute. If you want to build a high-efficiency solar panel, photovoltaic cell, you must use silver paste. China currently controls over 80% of the global solar panel supply chain. Their production targets for 2026 and 2027 are astronomical. They are building massive solar farms in the Gobi Desert and exporting panels to the entire global south. Analysts have been warning that the solar industry alone could consume 20% to 30% of the entire annual global mining supply, but those estimates were based on old technology. The new generation of TOPCon and HJT solar cells use 50% to 80% more silver per panel than the old models. China knows the math. They know the mines in Mexico and Peru are tapping out. They know supply is flatlining, so they are panic buying that $125 price tag. To them, it's cheap, because the cost of not having the silver and shutting down their solar factories is far higher. 2. The military-industrial complex. We are living in a world of drone warfare and smart missiles. Look at the conflicts in Eastern Europe and the Middle East. Every Tomahawk missile, every guidance system, every satellite, every fighter jet requires high-purity silver. In a potential conflict scenario, you cannot import silver from your enemy. You need it within your borders. China's aggressive bidding on the SHFE suggests they are engaged in strategic stockpiling. They are treating silver like oil. It is a national security asset. 3. The attack on the dollar. This is the layer that the mainstream media refuses to touch. The divergence between Shanghai and New York is a direct attack on the US dollar's hegemony in pricing commodities. For 50 years, the US has exported inflation to the world. We print dollars, and the world gives us real goods, by allowing the Shanghai price to run $17 higher than New York. China is incentivizing the world's miners to sell to them, not to us. If you are a silver miner in Mexico, and Shanghai offers you $125 while New York offers $110, where do you send your metal? You send it to China. This sucks the physical supply out of the West and moves it east. It drains the COMEX dry. Once the COMEX is empty, it loses its relevance. The US loses the ability to set the price of. We are standing at a historic crossroad. What is happening right now isn't just about the price of a metal, it is about the trust. The $17 spread between Shanghai and New York is undeniable proof the West is losing control over global resource pricing. If this gap persists, Shanghai becomes the center of true price discovery, while the COMEX becomes nothing more than a paper casino. So what should you do? For the stackers, physical holders, congratulations, your patience is paying off. Those high premiums you've been paying on coins and bars, those were the early warning signals from the real market. For the traders, be careful. A $20 weekly swing is a double-edged sword that can wipe out your account. Don't chase the top without seeing a consolidation. My final question to you is this. When China accepts paying a premium to secure real resources, and the West continues printing money to prop up paper assets, which side do you choose? The paper in your hand or the bar in your safe? Let me know your thoughts in the comments below. Is silver heading to $150 or crashing back to $90 next week? Don't forget to like and subscribe to stay updated on this currency war. I'll see you in the next emergency update. China has just locked the vault. Gold has physically vanished from American shelves at $4,500 an ounce. And the biggest bullion dealers in the US just admitted they are completely sold out of silver. Welcome to January 2026. While you were celebrating New Year's, the global financial system quietly broke. We have confirmation that Beijing has restricted silver exports, effectively choking the Western supply chain. The banks tried to crash the price on December 30th with a massive margin nuke, but it failed. The price didn't drop, it solidified. Experts are now projecting $100 silver within 90 days and $150 by year-end. If you are holding paper dollars, you are standing on a burning bridge, and today we expose the great squeeze that nobody is talking about. To truly understand the magnitude of this crisis, we have to look away from the manipulated charts on Wall Street and look at the forensic evidence from the ground level. We have analyzed a transcript from a veteran bullion dealer in the United States, a shop that has been operating for exactly 10 years as of this week. Their testimony provides a terrifying glimpse into the reality of the supply chain. Here is the situation on the ground as of the first week of January 2026. Gold is trading at over $4,500 an ounce. Just a few years ago, people said $2,000 was the ceiling. Now, at $4,500 plus heavy premiums, dealers are reporting zero inventory. The shop owner admitted that even at these historic highs, they cannot keep gold eagles or buffaloes in stock. If they manage to buy 4 or 5 coins from a walk-in customer, those coins are sold and gone within the hour. But the situation with silver is even more volatile. Silver has rallied an astounding 148% throughout 2025. We entered the new year with silver holding firmly above $70. To put that in perspective, just a year ago, the experts were calling for $28 silver. The dealers on the ground, however, saw this coming. They predicted $42, and the market blew past that to hit $72, and even spiked to $84 at the peak. What is happening right now is a phenomenon known as a liquidity squeeze. On December 30th, the COMEX, the primary futures exchange where the price of silver is supposedly discovered, executed a margin hike. This is a tactic used to flush out leverage. They raise the cash requirements to hold a contract, forcing traders to sell. The paper price flashed from $83 down to $70 in a matter of hours. The mainstream media called it a bubble bursting. They told you the rally was over. They told you to sell, but listen to what the dealers witnessed. When the price dropped on the screen, the physical buying didn't stop. It accelerated. The dealer noted that on New Year's Eve afternoon, while the paper price was bleeding, there was active buying. They bought everything they could. The shop owner confessed, "We were completely out. We were able to buy some later that morning, but it just doesn't stay." This is the critical signal. When the price drops and inventory vanishes, you are not in a bear market. You are in a bear trap. The whales, the high net worth individuals and the family offices, used that engineered crash on December 30th to sweep the floor. They took the last cheap silver off the market. The retail crowd, the average person, is still asleep. They think $70 is too expensive. They are waiting for a pullback to $50. They don't realize that $50 silver is gone forever. When the Chinese export ban fully bites in Q1, the price isn't going to $80. It's going to 3 digits. Now, we need to zoom out. We need to connect the dots between that empty shelf in Oregon and the geopolitical chessboard in Beijing and Moscow. Why is this happening now? Why has the supply chain suddenly snapped? This is what I call Operation Silverwall, the China connection for decades. The West has been comfortable letting China handle the dirty work of refining. We ship them the ore, they refine it, and they ship us back the .999 fine bars. It was a convenient arrangement, but on January 1st, 2026, the game changed. Intelligence reports confirm that Beijing has implemented a soft embargo. They haven't announced a total ban on CNN. They are smarter than that. They have implemented a new licensing regime for the export of strategic critical minerals, including refined silver. They are making it administratively impossible to get metal out of the country. You have to understand the leverage here. China controls between 60% and 70% of the world's refined silver capacity. They are the bottleneck. By tightening the screws on that bottleneck, they are creating a supply vacuum in the West. Why would they do this? Because they need the silver. The net zero trap. The United States and Europe have spent the last 5 years aggressively pushing a net zero 2030 agenda. They want to electrify everything. They want a solar panel on every roof, an electric vehicle in every driveway, and a 5G tower on every corner. Here is the fatal flaw in that plan. You cannot have a green revolution without silver. It is physically impossible. Silver is the most conductive metal on Earth. It is essential for solar photovoltaics. It is essential for EV circuitry, and it is essential for the AI chips that run the whole system. We are currently in a 6 to 7 year structural deficit. The Silver Institute's data confirms that. Since 2021, the world has consumed significantly more silver than it has mined. We have been eating into above-ground stockpiles. The vaults in London, LBMA, and New York COMEX have been drained to historical lows. Now, China has looked at the math. They see that the West is desperate for silver to build its military technology and its energy grid. So, they decided to keep the metal for themselves. They are weaponizing the supply chain. This is a perfect storm. You have declining mining yields, exploding industrial demand, and now, the primary refiner of the world, refusing to export. The Russian and BRICS factor. It's not just China. We must look at the BRICS alliance. Russia and China have completely stopped buying U.S. treasuries. They are no longer recycling their trade surpluses into American debt. Instead, they are buying hard assets. Russia has even proposed a separate precious metals exchange for the BRICS nations, one that would completely bypass the London and New York pricing mechanisms. They know that the COMEX price is fake. They know it is determined by paper contracts, not physical delivery. By hoarding physical metal, the East is preparing to break the Western pricing monopoly. The mining crisis, some of you might be asking. If the price is $70, why don't the miners just dig more up? This is the tragedy of the mining sector. You cannot print a silver mine. It takes, on average, 10 years to move a project from discovery to production. It involves permits, environmental studies, infrastructure. While you were sleeping, the rules of global wealth were rewritten by a silent stroke of a pen. At exactly 2 a.m. Swiss time, a physical wall was erected around the world's most critical industrial metal. There were no flashing sirens on Wall Street, no emergency broadcasts on major news networks, and no frantic tweets from the Federal Reserve. Just a quiet, surgical strike on the global supply chain that has effectively ended the era of cheap, available silver forever. Switzerland, the undisputed heart of the world's precious metals refining, has pulled the emergency brake. They aren't just freezing bank accounts, they are freezing the physical atoms of silver that keep your smartphone running, your electric vehicle charging, and the Pentagon's missile systems on target. Here is the paradox. Look at your screen right now. The paper price of silver, the neat little ticker flickering on the COMEX, suggests a world of calm, but that price is a ghost. In the real world, in the high-stakes backrooms of Tokyo, Shanghai, and Dubai, physical silver is already trading at premiums that would make your head spin. We are witnessing a systemic liquidity squeeze that the public isn't supposed to see. This is the rare earth's moment for the West. China has slammed the door, Switzerland has locked the gate, and the United States has just realized it is trapped, outside in the cold. Today, we perform a forensic analysis of the 2 a.m. freeze to reveal why the smart money is vanishing into the shadows, and why the paper market is about to suffer a violent, terminal heart attack. To understand the chaos, we must look at the crime scene. On January 1, 2026, China, the dragon that produces and refines a massive portion of the world's silver, officially reclassified silver as a national strategic material. In bureaucratic language, that is a kill switch. They didn't ban it, they licensed it, ensuring that only state-approved entities could move an ounce out of the country. But the real earthquake hit the Alps, the three titans of the refining world, Pamp, Valcambi, and Argor Heraeus, who together process roughly 70% of the world's refined silver, received a chilling notice from the Swiss Federal Customs Administration, effective immediately. All silver shipments over 1,000 kilograms are subject to a mandatory export license review. The minimum processing time, 14 to 21 business days. In the high-speed world of global logistics, 21 days is an eternity. It is, for all intents and purposes, a total freeze. Every major commercial shipment of silver is now hitting a bureaucratic wall. Bars destined for the U.S. Mint, granules headed to German solar factories, and kilobars promised to Asian investors are all sitting in Swiss warehouses, gathering dust. This isn't just a delay. It is triage. Switzerland produces zero silver of its own. It is a pass-through node that relies on raw material from China, Peru, and Mexico. With China cutting the cord, the Swiss vaults began to bleed out. Reports from insiders suggest combined inventories at the major refineries dropped to a staggering 8 million ounces, less than a single week of global industrial demand. Faced with a choice between serving the global market or saving their own domestic industry, the Swiss chose self-preservation. The valve is closed. Now, let's peel back the layers and look at the hidden war driving this collapse. Why now, and why silver? The paper illusion versus the physical reality. For decades, the global financial elite have used paper silver to suppress the true value of the metal. For every 1 physical ounce of silver sitting in a vault, there are hundreds of paper claims, ETFs, futures, and unallocated accounts. It's a giant game of musical chairs. As long as no one asks for their chair, the music keeps playing. But Switzerland just stopped the music. When you freeze the physical metal, the paper claims become worthless. We are seeing a structural fracture where the screen price and the street price are decoupling. If you can't take delivery of the metal, the price on your phone is just a meaningless number. The smart money knows this. They bypasses the exchanges and outbid everyone to secure what little physical inventory is left. The US-China economic war. Weaponizing the periodic table. China's export ban isn't a random policy. It's a strategic masterstroke in the ongoing war with the United States. Silver is the Achilles heel of the modern tech economy. The net zero trap. You cannot build a green revolution without silver. Every solar panel requires silver paste. Every electric vehicle requires twice the silver of an internal combustion car. By controlling the silver supply, Beijing effectively controls the speed of the West's energy transition. The military dimension. Silver is essential for high-end electronics and guided munitions and satellite tech. The U.S. defense industrial base is now staring at a supply chain that runs directly through their greatest rival, the corporate bloodbath behind the scenes. The giants are panicking. Imagine a German solar manufacturer that signed a long-term contract to buy silver at $80 an ounce, back when it was $25. Now the physical price is $150. The Swiss refineries are staring at billions in losses if they honor those contracts. If they don't, the manufacturers go dark. This is why the German government is reportedly calling Bern in a state of desperation. We are seeing a scramble for scarcity where corporations are now acting like sovereign nations, trying to bypass traditional markets to secure raw materials. The just-in-time inventory model has been replaced by just-in-case survival. The net zero paradox. The irony is biting. The very governments pushing for a net zero future have failed to secure the one metal required to achieve it. The demand from the solar industry alone is projected to consume 85% of global silver production by 2030. There is no plan B. There is no substitute for silver's conductivity. The math doesn't work, and the market is finally realizing it. Switzerland's 2 a.m. decision was the death knell for the old globalized system of trust. When the world's most reliable, neutral, and efficient refining hub decides to hoard its output for national security, it tells you that the system is broken beyond repair. The information asymmetry window is closing right now. The financial media is still treating this as a temporary procedural delay. But you don't use emergency national security language for a simple paperwork update. The refineries are running, but the silver isn't leaving. It's staying home to feed Swiss industries and fill the strategic reserves of the Swiss National Bank. So, what are the consequences? First, the era of low premiums is over. Paying 50% or 100% over the paper price is no longer an anomaly. It's the entry fee for the only market that matters. Second, the paper market faces a looming force majeure. At some point, the COMEX will have to admit they cannot deliver the physical metal at the paper price. When that happens, the price won't just rise, it will gap up to levels that seem impossible today. The 2 a.m. freeze was the starting gun for a race that most people don't even know they're in. The people who understand what is happening are moving in silence. They are locking in alternative supplies, securing physical custody, and preparing for a world where availability is more important than price. In the world of investigative finance, being early often feels like being wrong. Right up until the moment everyone else realizes they are too late. Switzerland just showed the world its hand. China just flipped the table. The question is, when the paper illusion finally evaporates, what will you actually own? The countdown didn't start today. It started at 2 a.m. Swiss time. The valve is closed. The music has stopped, and there are no chairs left. There is a theory in chaos mathematics called the butterfly effect. It posits that a butterfly flapping its wings in Tokyo can cause a tornado in New York in the high-stakes world of global finance. This is no longer just a mathematical theory. It is a cold, hard mechanical certainty. While the mainstream media remains pathologically obsessed with the Federal Reserve's next move, the theater of the U.S. election cycle, or the latest geopolitical skirmish in Venezuela, they are blind to the single most dangerous chart in the history of modern finance. This chart has just shattered a 25-year trend, signaling the absolute end of the free money era. I am talking about the Japanese government bond yields, specifically the 30-year yield, which has just surged to a staggering 3.5%. To the average person, these are just boring numbers on a screen, but to the institutional plumbing of the world, this is a catastrophe. For 2 decades, Japan has acted as the global ATM, printing unlimited yen and keeping rates at zero. But today, that ATM is not just closed, it is demanding its money back. The yen bomb has detonated, and the timer just hit zero. To understand why 3.5% represents a global disaster, we must pull back the curtain on the game Wall Street has been playing since 2001, known as the yen carry trade. Imagine you are a veteran hedge fund manager in New York. You want to buy Nvidia, Bitcoin, or US Treasuries, but you don't want to use your own capital. You want leverage. You look for the cheapest loan on the planet, and you find it in Japan, where the Bank of Japan has maintained interest rates at zero or even negative for years. You borrow 1 billion yen at virtually no cost, convert that yen into US dollars, and buy assets yielding 5% or 10%. You pocket the difference as pure profit. This free money engine has pumped trillions of dollars into Western markets, acting as the primary liquidity driver for the massive asset bubbles we see today. However, this entire mechanism relies on one fatal assumption, that Japanese rates will stay low forever. That assumption has just evaporated. The Bank of Japan has officially lost control as inflation forces them to tighten their grip. When the 10-year yield crossed 2.13% and the 30-year hit 3.5%, the golden number was breached. Japan is a nation of savers, with massive pension funds and life insurers that have been forced to invest offshore for decades because they couldn't find yield at home. They are currently the largest foreign holders of U.S. debt, owning over $1.2 trillion in treasuries, but now they can get 3.5% risk-free at home in Tokyo without any currency risk. The great repatriation has begun. Japanese investors are selling their U.S. bonds and pulling their capital back to Tokyo. This creates a massive liquidity vacuum in the heart of the Western financial system. When the largest buyer in the room leaves, the floor falls out, and that is exactly what we are witnessing right now. This is not merely a Japanese crisis. It is a global margin call that is about to ripple through every asset class. When the yen strengthens and Japanese rates rise, those trillion-dollar carry trades become toxic. Hedge funds that are over-leveraged must sell their winners, their U.S. tech stocks and their crypto, just to pay back the yen they borrowed. This creates a wave of mechanical selling pressure that has absolutely nothing to do with economic fundamentals or corporate earnings. We are entering a deleveraging event that will expose the shadow casino of the global banking system. The notional value of global derivatives tied to interest rates is estimated to be near $1 quadrillion. Most of these are bets that rates would stay stable. As Japan pushes global yields higher, these derivative bets are blowing up, creating a credit contagion that will force the Federal Reserve into a desperate corner. The United States government is currently running a deficit of $2 trillion a year, requiring a constant stream of foreign buyers to keep the lights on. But with China selling and Japan repatriating, the U.S. Treasury market is facing a terminal collapse. To prevent interest rates from spiking to 7% or 8%, which would make the U.S. government insolvent, the Federal Reserve will be forced to implement yield curve control. They will have to become the buyer of last resort, printing infinite new dollars to buy the old bonds that Japan is dumping. This is the ultimate surrender. It means the central bank has prioritized the solvency of the government over the value of the currency. Once the market realizes that the supply of dollars is going vertical to save the bond market, faith in fiat currency will vanish. This is the precise moment when capital flees from the leveraged paper economy and into the real economy of hard assets. Silver is the primary beneficiary of this systemic shift because it sits at the intersection of monetary history and industrial utility. Unlike a treasury bond or a bank deposit, silver has no counterparty risk and cannot be diluted by a central bank printer. In the initial phase of this liquidity shock, everything gets sold, and we may see silver prices dip as traders cover their margin calls. But once the smoke clears, the rush for safety will be unprecedented. We are looking at a dual driver for silver: the Fed's desperate printing to absorb Japanese selling, and a surge in industrial demand from a manufacturing-heavy Japan that now has a stronger currency to buy raw materials. This is not a speculative rally, it is a monetary flight to quality. We are repeating the cycle of the 1970s, where bonds crashed and precious metals went to the moon. But this time, the debt levels are 10 times higher and the exit door is much smaller. The yen bomb is the pin that has finally popped the global debt bubble, marking the definitive end of the era of cheap money. We have moved past the point of speculation and into the era of a violent global repricing. History gives us a clear roadmap for what happens next. In every major crisis, from 2008 to 2020, the response has always been the same: massive liquidity injections. When the Fed eventually surrenders to yield curve control to save the banks, silver will not just rise, it will explode. We have established conservative price targets based on the gold-to-silver ratio compression. At a $4,500 gold price, a return to the historical ratio of 41 puts silver at $112. In a true panic, similar to the 1980s, that ratio could collapse to 15:1, sending silver toward $300. However, you must be prepared for the journey. The path from $70 to $300 will not be a straight line. It will be a jagged, violent trajectory filled with shakeouts designed to scare you out of your position. The smart money wants your physical metal so they can cover their paper shorts as the system breaks. Do not let the volatility of the carry trade unwind steal your future. If you own the metal and avoid leverage, you can ride out the storm while the fiat system burns. The yen is moving, the bonds are breaking, and silver is the next domino to fall. Hold fast, because the great repricing has only just begun. The global ATM is out of order, and the only currency that will matter is the one you can